Welcome to People and Profit, where we look at how business shapes our world. I'm Stephen Carroll. Coming up, a choreographed slowdown in Chinese growth. But what's really going on in the world's second largest economy? Rate rise rumbles. We're asking if America's ready for a new normal for interest rates as the economy there powers ahead. And we're going behind the scenes of India's growing wine industry and uncovering the French connections in their vineyards. First up, though, China's economy has a new target. The government has set a growth rate of 6.5% for this year, down from 6.7% last year. In theory, it's just a goal, but in practice, the figures tend to match expectations very closely. At the annual meeting of China's rubber stamp parliament, Premier Li painted a positive picture for the year ahead.
We have the following projected targets for development this year. GDP growth of around 6.5% or higher if possible in practice. Consumer price index kept at around 3%. Over 11 million new urban jobs and a registered urban unemployment rate within 4.5%.
Well, to talk about this further, I'm joined now by Keyu Jin, lecturer in economics at the London School of Economics. Dr. Jin, thank you for speaking to us on France 24. When we talk about figures like 6.5% growth for China, how closely does that represent the reality for the Chinese economy? It sounds like very impressive growth.
No, I think it is, for the current situation, quite realistic. It is, already revised down. We don't want to see China as a kind of an economy whose growth engine has halted. There is actually still a lot of room for growth. The question is whether the key reforms are going to be implemented. But currently, we see a lot more economic activity because the manufacturing industry has somewhat recovered, partly thanks to the rise in commodity prices and partly thanks to the fiscal stimulus. So I think from all leading indicators, this 6.5% target is actually realistic.
And when you talk about reforms, this is the shift in the Chinese economy towards consumer demand, towards generating more of its own, I suppose, demand for its goods as well. Is there a long way to go on that road still?
I see the core reforms as more being in, breaking down state-owned monopolies, reforming the financial system. I think this is the most direct way that will actually raise demand in the economy. I think there are very few policies that can directly target on consumer spending because, to face it, Chinese people save a lot, and these are due to structural forces, not so much policy. But why do Chinese save so much? Well, first of all, if they put their savings in their banks, they're earning no real income, real return to income, because real interest rate have been zero. So I think that to talk about a demand-oriented economy, you have to get the system, clean up the system right, starting from the financial system and the state-owned enterprises. So what the government is tackling at the moment, but finding a lot of difficulty, is to push precisely through these particular kind of reforms.
And where are those difficulties coming from?
A lot of it is now political. In 1978, Deng Xiaoping had this ideological revolution, which is everything has to be economics. Today, everything is political. There are vested interests who want to protect themselves. There is a misalignment of incentives in terms of the government institutions that are in charge of particular reforms. For instance, the state-owned enterprise reforms have no incentive to change whatsoever because that is their raison d'être. That is where their power lies, to strengthen the state.
One of the worries that we often hear mentioned when it comes to the Chinese economy is debt. There's massive amount of debt for companies. There's a massive amount of local government debt. How worried should we be about that in 2017?
Well, most of what we hear from the public opinion is using the lens of the Western kind of framework. In that sense, these figures are staggering. However, I want to mention that the credit boom, the rising debt, is in large part due to a supply issue, not a demand issue. Not so much as corporates and local governments borrowing more, but a relaxation of constraints. What I mean by that is when the government implemented the 4 trillion fiscal stimulus in 2008, it led to a huge expansion of kind of borrowing on the local government's part, because that acted as a relaxation of constraints for them. And so same thing with the banking side. After the liquidity regulations were put in place in 2008, the wealth management products were created, smaller banks started to lend more, and they generate more credit per unit of savings. This is why we're seeing a credit boom. So we are not of the view necessarily that these numbers are unsustainable. It's that the local governments were so highly constrained because of 1994 tax reforms that in order to borrow and undertake some of these large urban development projects, they had to set up these alternative vehicles to find alternative financing. So in sum, there are enough tools for the moment to manage the current financial risk.
So you don't share the view of the Bank of International Settlements that a banking crisis is a risk in China?
I don't share that for the time being, for the foreseeable horizon. First of all, the channel of transmission that we saw in the West and after the recent crisis of the banking sector, transmission of shocks, is not what's going on in China. Precisely because of what I mentioned, a lot of what we're seeing in terms of the credit boom came from financial innovation, although that contains a double-edged meaning so far, but it's also relaxation of the constraints on the supply side. But also there's a lot of coordination. There could be coordination between the central bank and the four major state banks to act quickly in case there are any problems. Now, the real risk is that the housing price collapse, if there were to be one, could potentially lead to an onslaught of these chain events that could affect deeply the banks.
The new US President Donald Trump is talking a lot about China. He's talking about trade policy. Is that the sort of thing that could have a negative effect, that could derail China's economic growth?
There's definitely mounting trade frictions. It has somewhat eased as President Trump has focused a little bit more attention on some of the domestic issues. However, the Chinese government is quite prepared for these kind of trade frictions or even trade war escalating. I think it would hurt the US at least as much as it would China.
OK, Dr. Keyu Jin from the London School of Economics, thank you very much for speaking to us.
Thank you.
Next, America's central bank is expected to raise key interest rates later this month for only the third time in a decade. Federal Reserve Chief Janet Yellen says the key indicators of unemployment and inflation are improving in line with the bank's expectations. The expected quarter-point rise will take time to trickle down to the average American consumer, but it will increase the rate of interest they pay on mortgages, car loans or credit card bills, as well as the rate of return on a savings account. But what is the Fed's final target and how high will interest rates go? Well, Kate Moody's been finding out. Kate.
Stephen, since 2009, the benchmark federal funds rate has hovered at record lows near zero. 2 rate hikes in the last 2 years have brought the range to between 0.5% and 0.75%, and they're expected to rise another quarter. But historically, that remains extremely low. The Fed's interest rates hit an all-time high of 20% in 1980. There were small dips in the 1980s, 90s, and at the turn of the century, but rates well above 5% were considered the norm. We may not be heading back to those levels, though. Fed Chair Janet Yellen has said that the recent trend of strong economic data might make it appropriate to move towards a neutral policy stance. Economists describe it as the Goldilocks policy, not too hot and not too cold. Another name for it is R-star, the equilibrium real interest rate. That's the Fed's target when the economy is stable. As recently as 2012, the R-star was listed at 4.25%, but more recent estimates put it closer to 2%. Some analysts say that means rates might never return to levels that were considered normal just a few years ago. One top Fed official has predicted that low rates will remain persistent. Now, much of the Fed's future action and the health of the U.S. economy will depend on Donald Trump. Some of his policy proposals could lead prices to rise faster than expected and outstrip the Fed's inflation target. That, in turn, could force the bank to raise rates faster and more sharply. The president's forecast for 4% GDP growth is much higher than the Fed's own predictions. While economists say his plans will likely boost activity in the short term, a cloud of uncertainty hangs over the longer-term impact, all of which the Fed will have to navigate. Stephen?
Kate, thank you very much for that. Now, India may be well known for its tea production, but it also has a burgeoning wine industry. Vineyards have sprung up in several parts of the country, and many are drawing lessons and inspiration from France. Simon Harding tells us more.
250 acres of vineyards, a sight that you would expect to see in France, but these grapevines are in India. This is the country's second largest vineyard, and in a massively growing business, many of the wine growers were taught by French professionals.
Specific of France, like this is more concerned to the quality aspects of the grapes. This is more concerned to the old world winemaking styles.
French expertise copied through and through in a country where wine drinking is far from being a tradition. Many of these workers have never even tasted it.
Why don't you drink wine?
We're not used to it.
How long have you been working here?
16 years.
And you've never tasted some?
Never.
A business which is growing exponentially. This Franco-Indian entrepreneur makes 1,300,000 bottles a year and has injected 47 million euros into developing Indian wines, an investment which he thinks will pay off.
Wine is a product which people aspire to in India. It's like a dream. Only a few years ago, the market was obsolete. But its growth that has been spectacular, over 20% a year, and that trend will continue in the next 20 years.
Indian wine, despite copying the French template, remains unusual. A Goya or even pineapple taste, flavors which appeal to Indian customers who regard it as a special product.
I've only tasted a few, but from those I would say